Good morning, Dhruv. Thanks for joining us. Beginning of the fourth quarter here, we'd love to chat with you, figure out some of the things that you're seeing out there in the market. We'll talk about some public markets, talk about some private markets. But why don't you lead us off with maybe some themes that you're seeing out there, some interesting stuff you've seen in the public markets lately?
Yeah, pretty interesting quarter. Lots happened so far. So if you go back and just look at what's happening in the economy, you can see this tension between what the Fed is trying to do to keep inflation contained, but also you're seeing signs of weakness. So the impetus now is to lower rates a little bit more. And inflation is still not contained and not gone back down. At the same time, the monetary spending and the fiscal deficits are ballooning and skyrocketing. So you're starting to see now markets anticipating just rates coming down more and more. Inflation, at least the risk of inflation, is going up a little bit. And you're starting to see that reflect a lot in the price of gold. So gold miners, which we have an investment in, are up, at last count, 130% for the year. We've been on this for a while because we have been concerned about the fiscal debasement. And it's really, I think, getting front and center stage now in investors' mindshare. So you have really, I don't want to call it stagflation, Mac, but that's too far away. But
right, let's not throw that term around.
Yeah, let's
loosely.
not do that right now. Exactly. But it is, you're seeing whiffs of it. So once this thing starts, it's hard to contain it. You're also seeing the US dollar decline because you don't want capital flows coming from outside the US into the US because of all the tariff issues with the tariffs.
Right.
So lots going on from an economy standpoint. So, just from a market standpoint, I know you're seeing a lot on the private side that maybe we swap to in a second, but what's been really interesting this last quarter is the amount of AI-related fervor, speculation, call it whatever, in the markets. And it's been a really low-quality, junky rally. So markets have had a really good quarter. Markets have gone up quite a bit since they bottomed in April after the tariff issues. But what's really interesting is if you are, let's just take mid-cap and small-cap stocks, if you have negative earnings, you up 35, 36%. If you are a profitable company, you're up 17% since then. So the more unprofitable you are, the more you're going up. So if you are in a more disciplined portfolio and you're being thoughtful, then you are lagging. Similarly, like if you look at even large cap stocks, if your sales growth is the lowest sales growth for those companies are the ones that are outperforming the most. So again, there's this element of speculation that is really interesting. And I will say it feels for the first time, having invested through 2000 and 2008, the feeling of trying to do the right thing for clients and lagging, which we are in equities this year, it feels very similar to that. So that's one thing. And related to that, Mac, I'd love your thoughts on AI in a second, but just from an artificial intelligence standpoint, if you just draw circles of companies that are closest to the AI boom, they are the ones benefiting the most, even though you're seeing really questionable transactions where the OpenAI runs ChatGPT,
right.
NVIDIA builds the chips, OpenAI needs NVIDIA chips. Well, OpenAI is a customer, they're buying all these chips from NVIDIA, and OpenAI does not have that much cash, so NVIDIA is making an investment in OpenAI. It sounds similar to what Cisco and Lucent did in 2000 when the tech bubble crashed. So we're seeing some of that as well.
Incestuous, would that be the word?
I don't know if we can say that, but I would say yes.
How about super interconnected? How about that? With all the AI
super
companies.
Entangled. Let's just call. Yeah, exactly.
Yeah.
And
that market that you're describing seems like a very tough market to be a stock picker in, or to be a theme picker in. And so everybody always wants to talk about short-term stuff. What about longer term? Do you see, like, what could you tell somebody for their longer term outlook?
Yeah, that's a really good question too, because I think people assume that they have a birthright to 10% returns in the equity market. Yeah. And the truth really is the price you pay for getting those returns is emotional turmoil. Hate to use this overused word, discipline, but just being centered and not getting carried away by what's happening in the moment. So look, if you are investing in companies that are growing earnings, are higher quality, they can take those earnings and reinvest back in the company and continue to grow. And that's what Warren Buffett's approach has been. You do really, really well over the long term. Mm-hmm. But companies like Warren Buffett, Warren Buffett was called, to paraphrase, since we used incestuous, I can say idiot, was called an idiot in 2004 or in 2008 in just the tech bubble because he was lagging behind so much. Mm-hmm. But the performance has been excellent. So over the long term. And that's the right approach to take, Max. So over the long term, markets are expensive, but if you are allocating to the right areas and just take the noise out, I think you are able to do well. But if you're getting carried up in the noise and you're investing in companies that are losing money just because you can participate in that, that will reverse and that will hurt over the long term. So let me ask you a question here. Mm-hmm. What do you think S&P 500 has done since 2000, since we've had so much happen? And we've had AI, we had the internet, we had the tech boom. It's been a golden age almost, seems like. Right. Markets all-time highs.
All-time highs. Annual return since 2000. Everybody thinks they're entitled to the 10%, but let's go right below that at 9%. It seems like things have been really good. I don't know.
Well, it's not. You close. It's 7.5%.
Okay.
So,
but this is the golden age, and it's only 7.5%.
Well, because you're investing in the market at a really, really expensive valuation. Right. If you actually invested in bonds at 2000, I think bond yields were long-term bonds yield. I could be wrong, maybe close to 6%. Mm-hmm. So you've taken all this up and down risk over 25 years to be up 7.5% to 8% when you could just be in bonds. So the valuations are a really, really powerful force long term. Short term, who knows?
Right.
So,
and then if you want to go back, we can kind of circle back to the AI phenomenon. Yeah. You talked about it, kind of what you guys are seeing and how you think about it in the public markets. In the private equity world, which is where I spend most of my time, it's honestly, it's a theme you can't even get away from because it doesn't matter. Like we think about AI as a sector almost in and on itself, but it's really not. It's embedded in everything. We'll have a healthcare buyout firm come in, and they're talking about AI for 30 minutes, of the 1 hour meeting. It's embedded everywhere. It's tech-enabled services. AI has something to do with everything. In fact, yesterday we were talking upstairs, a couple of the IT investment professionals, and we were trying to figure out a way, how can we use AI to make True North better, right?
Does it remind you of like how every company in .com had a .com added to their name?
Yes. Yeah. Yep. And so, we back in 2022, we found a group that was really unique in two ways. One, they were focused on AI. So this was relatively early. And then the second thing that we really liked about them was that it was a venture capital group focused on AI and cybersecurity, but they were also focused on the East Coast VC community. So it wasn't the traditional Silicon Valley West Coast VC guys. And we've had a really good experience with them. And so we pride ourselves on finding those themes that are going to be embedded in everything. We want to find them early. Because if you're jumping into the AI space now, a lot of those opportunities, you've missed them already. And fortunately for us on the private equity side, I know on the public market side, you have to be diversified. On the private equity side, we can take a little bit more risk. We can take our shots here and there with some themes that we think are going to be profitable. And we successfully did that in the AI space.
Did you say when we made that investment, Matt?
It was 2022.
So I think that's a good example, of being ahead of the curve, because ChatGPT, I think, launched in 2024, I believe, if that's when it became really popular. Yeah, if I recall correctly, you may know more, Mac, but it seemed like some of the things that were happening with that venture investment was actually improving manufacturing processes, doing like real things as opposed to betting on the big AI theme. It's almost
Right.
like investing in the
Right.
internet in
Yes.
2000.
Yep. Yeah. And that's the thing is, again, kind of going back to AI and how it's embedded in everything, right? Those will be, I think, the companies that are really successful, short term and long term, are the ones that can find a way to figure out how to be more efficient using AI, because it's here and it's a
Right.
tool that's very, very useful, right?
Right.
It can be at the very top of a company. It can be at the very bottom of a company. And that's what I was saying yesterday. With a couple of the IT professionals, we were trying to figure out a way where AI can help us on the diligence side.
Right.
We're looking at 500, 600 maybe private equity and private credit funds a year, and we have to narrow that down to 7, 8, 9, 10. And so we were just,
Right.
looking at ways to be able to better do that using AI.
And like you said, that's when you have really good insight into which companies are in the portfolio, how they're
Yep.
thinking about it. So you should be more targeted rather than trying to be more spread out in the private space.
That's right. Yep.
It's actually interesting about our portfolio too, because if you looked at the public part that I just talked about, we don't like AI that much because it's expensive.
Mm-hmm.
You cannot put 35% of your money in the public portfolio into a few AI companies
Right.
because they're just trading with each other.
Yeah.
But whereas we have the ability, if you're not there, we can do it in the private space. So
Mhm.
overall, we still have exposure. It's just shifted from the public space to the private space.
Correct.
Mac, what else are you seeing in the private markets that's interesting?
We are concerned with liquidity, just like everybody else in the private equity and private credit world. But we're definitely concerned with liquidity. Our oldest private equity vehicle, our oldest diversified private equity vehicle is about 6 years old now. And when you look at the distributions that have come out of that vehicle,
Right.
we're not where we told clients we were going to be six
Right.
years into this vehicle. And so we are very concerned. The good news is on that front is that the public markets have done really, really well. And so the IPO space is opening ever so slightly.
Right.
And so that's been good for us. One of the other really good things is that the whole continuation vehicle phenomenon,
Right.
where general partners of private equity funds, they're not going the traditional exit route and completely selling off a portfolio company. They're actually bringing in a secondary buyer, or they're bringing in a bigger private equity firm to come in and buy the company, and they give their limited partners a liquidity option.
Right.
We're really taking advantage of that. That's helped us out a lot. And as that space grows, it will continue to provide some liquidity for us. So we're happy about that. Fortunately, we play in the lower middle market space. And so our managers, this whole phenomenon that does get some bad publicity about private equity firms selling to private equity firm.
Right.
We're not on the buy side, we're on the sell side. So
Right.
we don't mind it as much, right? That's
Right.
that's an exit avenue for us.
Right. All the capital's been raised here by the big guys, and if we are investing here,
Right.
they're natural buyers of our portfolio.
That's right, and they have to put it to work, and so they come downstream a lot.
Right.
And there's other things that we're looking at. We have a diversified private equity vehicle every year. We're looking at investing in shorter duration underlying either funds or shorter duration underlying direct deals that help get the cash flow back quicker. A couple of those are like multifamily residential,
Right.
Because then the rents are coming in, so it's an income producing asset. And so by doing, we feel like that's the right thing for our clients.
Right.
Two, we want to be able to turn the vehicles over, right? We want to be able to bring the cash back in. We're all invested alongside our clients, and so it's good for all of us.
Right.
So yeah, but to me, that's the biggest thing in the private equity space today is the liquidity, getting the distributions back in. That's our biggest concern.
What really happened after 2020 that caused distributions to slow down across the industry?
Yeah, there's a couple of things. Interest rates, when they went up, I know that was a year or two after that, but interest rates going up really changed the private equity world, right? The private equity world, the model of doing traditional private equity had gotten used to, not interest-free, but very cheap debt. And so a lot of deals were turning over, right? And so when that went away, it changed the way the model had to work. And so a lot of groups were slow to adapt to that.
Right.
Again, fortunately for us, we play in the lower middle market space. The guys we invest with are more flexible. But they weren't able to, the liquidity problem still hit them. They weren't able to sell, just like the big guys weren't able to sell. The IPO space kind of closed down.
Right.
It froze up, and so that really affected, the larger mega buyout funds. It also affected the VC funds, right? Because a lot of those smaller companies go public. And so I think those were the two main drivers of that. And it's just a different private equity world. We pride ourselves in investing with guys that are flexible though, and they can make those changes. They can adapt to stuff like that. And so we still definitely believe in our model. We think that our model is strong. And
yeah, the interesting thing is that also that if you look at the big endowments right now who plowed a lot of capital in their private market portfolios, now they want liquidity and distributions. So they are forced sellers into the market.
That's right.
And now we are looking at those sort of deals to be able to buy at more distressed prices.
Yeah, the secondary world has completely changed in the past decade, right? I mentioned the continuation vehicles before. GP-led secondaries is a really big thing now. I'd meet with a secondaries focused shop, and they would just come in. All they talked about was the discount that they were getting assets at. Now, when I meet with a secondaries focused firm, they come in and they talk to me about the solution they provide for the seller, because that's really what it's about these days, is providing a solution. Whether you're talking about an endowment or whether you're talking about a corporate pension or a state pension, those guys are, the secondary market actually used to be kind of taboo, where if you did go out into the secondary market, you didn't want it making the news.
That's right.
It was perceived as a negative thing. It's not a negative thing anymore. It's a portfolio management tool.
Right.
And so as that market grows, we're definitely seeing some opportunities there. We've been looking at a late term secondaries focused shop to invest in. Because again, we don't want to do an early secondaries because then that liquidity problem gets kind of stretched out. We want to do a late term secondary shop to where the duration will be shorter. And so, there's little things like that you can do that we feel are the best thing to do for clients, and just the best thing to do in today's private equity world.
Yeah, it kind of also raises the point that, investing is investing, be it public markets or private markets.
Right.
You're just making a decision on what's the right thing to do. And so if you are disciplined, if you are a liquidity provider when others are selling, if you can keep your discipline, not get out of your skis when things are just bubbly, reserve your capital and use it when there's distress, you're going to do really well over time, be it public markets or private markets.
All right. Well, Dhruv, thanks for joining us. That was a good chat. I hope it was helpful for our investors, and hopefully we'll see you next quarter.
Thanks, Mac.